I now hand the conference over to Mr. Atul Mehta, Chairman and Managing Director, Compuage Infocom Limited, for his opening remarks. Thank you, and over to you, sir.
Thank you. Good morning, ladies and gentlemen. Thank you for joining us on Compuage Infocom Limited's Q4FY21 earnings conference call. I hope you and everyone around you is safe and in good health. Along with me today, we also have SGA, our investor relations advisors. We have uploaded our press release and results presentation on the stock exchanges, and I hope everybody had a chance to go through the same. Let me first start with the business highlights. I'm very pleased that the company has continued the recovery momentum, growing its Q4 FY21 revenue by approximately 7% on quarter-on-quarter basis, EBITDA by 44% quarter-on-quarter, and profit after tax by 24% on quarter-on-quarter basis. Even on year-over-year basis, we have posted revenue growth of 3.3% during Q4. However, profitability was impacted due to higher competitive intensity. FY 2021 was one of the most challenging and eventful year for the company. Many of the industries witnessed unprecedented levels of disruption in FY 21, which completely changed the working dynamics of the industry. Gratefully, IT industry, after being impacted for a brief period of time during the start of the year, bounced back much stronger when the things started to normalize as lockdown restrictions were eased. Sustaining the business and profitability during FY21 took precedence over chasing growth for us. We are extremely pleased to have come out of the pandemic year relatively unscathed on the back of consistent business development and cost optimization initiatives. We are also into the process of consciously focusing more on higher profitable brands and segments to realign our capital to utilize it in the most efficient way to ensure better capital allocation. Although second wave of COVID-19 lockdowns has somewhat impacted the business recovery momentum, but our business development team has ensured that the time doesn't go unutilized by signing two new partnerships. These include distributorship agreement with Optoma Corporation for enabling resale of interactive flat panels in India. This tie-up would further strengthen our company's foothold in the audio-video channel segment, thereby enabling us to offer a better product basket to our partners in information technology. Another one is with Dawa Technology, whereby they have extended the distribution agreement to cover an additional product line of storage business, that is, for solid-state drives on pan-India basis. Extending the relationship to cover additional product line is a testimony to our excellent serviceability and vendor satisfaction. Although Q1 has been impacted due to COVID-19 lockdowns, we believe the business recovery would be much more stronger and sustainable in times to come once the pandemic subsides. Let me give you an overview of our consolidated Q4 and FY21 results. Total income for Q4 FY21 stood at rupees 1,082.9 crores as compared to rupees 1,048.4 crores in Q4 FY20, up by 3.3% year-over-year and up by 6.9% quarter-over-quarter. Total income for FY21 stood at rupees 3,447.2 crores as compared to rupees 4,249.2 crores in FY20, down by 11.8% year-over-year. Gross profit for Q4 FY21 stood at rupees 51 crores as compared to rupees 54.8 crores in Q4 FY20, down by 6.9% year-over-year, but up by 15% quarter-over-quarter. Gross profit for FY21 stood at rupees 169.9 crores as compared to rupees 194.9 crores in FY20, down 12.8% year-over-year. EBITDA for Q4 FY21 stood at rupees 32.9 crores as compared to rupees 32.3 crores in Q4 FY20, up 1.7% year-over-year and up by 43.9% on quarter-over-quarter basis. EBITDA for FY21 stood at rupees 94.4 crores as compared to rupees 105 crores in FY20, down by 10.1% year-over-year. EBITDA margins for Q4 FY21 stood at 3% as compared to 3.1% in Q4 FY20 and 2.3% in previous quarter. EBITDA margins for FY21 stood at 2.5% at similar levels to last year. PAT for Q4 FY21 stood at rupees 7.6 crores as compared to rupees 10.5 crores in Q4 FY20, down by 28% year-over-year but up by 24% on quarter-over-quarter basis. Before concluding my part of the speech, I would like to say that FY21 was the most challenging year the company has ever faced. However, this year gave us opportunity and learnings about the new ways of doing business and deeply analyze the cost structure to make it more efficient. Lessons learned during this year has made us much more wiser and much more capable to face any future challenges it may come. Our focus going ahead would be to keep adding meaningful brands to widen our product offerings, improve profitability through better product mix and cost optimization initiatives, keep on improving our serviceability and thereby create value for all our stakeholders. Finishing the year on a positive note and a good business outlook ahead, we have decided to continue our uninterrupted dividend track record. Hence, we have proposed a final dividend of rupees 0.2 per share, subject to approval of the shareholders at the AGM. With this, I now open up the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Asim Bharti from DM Capital Advisors. Please go ahead.
Yeah, hi sir, morning. Thanks for the opportunity. For my first question, I would like to ask, how are you doing in terms of procurement from your vendors? Has the semiconductor shortage globally led to supply chain tightening for your vendors, and as a result, is that hurting Compuage in doing business, basically not being able to cater to ground level demand because of the supply issue?
So, you're right. There are some supply constraints, especially in the laptop category of products because of surge in demand not only in India but globally, and therefore there is some disruption, but it is not as much felt now as it was possibly felt about 6 to 9 months back. I think things have improved substantially. A lot of sale has happened, and of course sales will continue because there is a large untapped market. But things have improved substantially over last year.
And in the current juncture, do you any sense on by when do you think that the semiconductor shortage should be balanced out with demand? Like, would it take another 6 to 9 months before the demand supply gap matches evenly, or would you think there would still be some time over there?
It's very difficult to comment on it for the simple reason that the semiconductors demand has increased because of wider application and wider use of the same. You know, with everything getting connected, the products are the semiconductors are being used in a much wider product application. And with huge investments involved in setting up a new facility. So I don't think I will be able to comment on it whether the demand and supply should match up in 6 months' time, 12 months' time. It will all depend upon how the demand is being catered to by the addition of new facilities in the market.
Okay. Okay. And would you, can you tell me, like, who are the top 5 brands with whom you work with in the distribution business?
So the top brands that we work with are Asus, HP, Cisco, Microsoft, SanDisk, Dahua, Comscope. These are the top 6-7 brands that we work with.
And how much would that be contributing to your revenue?
I think they would contribute close to about 65% of our revenue.
65?
65.
65. Okay. Okay.
Yeah.
Sure, sir. So, okay, thanks, sir. So, the second question, I just look at your full year numbers. So, revenue is down 12% YOY, but receivables are still flat on an absolute basis. So, like, can you talk about that? Why would have receivables days risen, and do you have any strategies to bring this down this year?
So, basically, while business did revive in the second half of the year, the cash receivables part was not keeping pace with the revival because there were cash flow challenges, especially in the enterprise side of the business. And that was the reason why the receivables have improved. And while we are doing everything possible in terms of ensuring that our money comes in on time and we don't take aggressive calls in pursuit of business, we want to keep the business hygiene foremost as far as the company is concerned. So while things were getting back on track, it is once again affected on account of this wave 2, and therefore we will see some time before it normalizes.
Okay. And final question on your non-distribution part of the business, basically cloud computing and hardware services. How much does this contribute to revenue, and how is the working capital profile here different compared to the traditional distribution?
So cloud computing is absolutely part of the distribution business. The way we distribute our software products, hardware products, we distribute cloud, it is through partners only. It's B2B. We don't engage directly with end customers except supporting them through partners wherever required. And therefore, it is part of our distribution strategy and part of our distribution business. The receivables are again in line with our receivables of the enterprise business. So it is no different. That is on the cloud computing side. As far as the hardware services go, I'll just give a little update on it. What we do is we sign up with the brands as their authorized service provider. We have signed up with 6-7 brands, the leading ones being Xerox, Vertiv, Asus, HP, and a few others. So when typically most of our business is servicing customers during the warranty period. So when a customer calls a toll-free number of Xerox or Vertiv or Asus or HP, they take the call and divert it to companies like us who are their authorized service providers. We fix the problem and then we get compensated by the brand themselves. So while we are serving the end customers, we don't canvas for business from the end customers. The business is routed to us by the brands themselves. It's again like a distribution business. We are conduit in taking care of the services. In terms of receivable cycle is almost similar. But it's a profitable business. We don't mind. In fact, it's a little longer in terms of the receivable cycle is concerned. And in terms of the top line, it's a very, very small percentage of our business at this point of time. It is contributing less than 1%. In fact, it is contributing approximately, I would say, close to about 2% of our revenue.
The working capital broadly for both these businesses is similar to the enterprise business that you said.
Yes, absolutely.
And for enterprise business, the working capital would be approximately how different versus your traditional distribution business?
So, enterprise business, I would say, would entail a little longer working capital cycle by about 30 days.
Okay, sure. Thanks a lot for answering all my questions and wish you all the best.
Thank you.
Thank you. The next question is from the line of Nagraj Chandrasekhar from Laburnum Capital. Please go ahead.
Also, good morning and congrats on a very good set of results. Just starting off with the margin we made this quarter, 2.75% operating margin. What really drove this? And are there some structural elements to this, such that distribution margins for everyone can be much higher now, because the smaller distributors, the regional guys who have, a couple hundred crores of revenues here and there in different regions of India, a lot of them would have had stressed balance sheets and might have exited the business. Has this somewhat taken up margins structurally, or is it a sort of 1 quarter, 2 quarter phenomenon because you've seen a tightening of supply versus higher demand due to work from home, and you've had lower inventory write-offs and lower data write-offs? So what really sort of drove this, and is it sustainable is the first question.
I'm sorry, can you come to the first part of question again? I'm not very clear. You're talking about the
distribution margin. Yeah, the operating margins, the 2.75% margin, which is much higher than what you've historically done.
Right.
Is it something structural that's driven it, or is it a one-off, or is it driven by maybe a reversal of inventory, prudential write-offs we usually do, data write-offs? What really drove this?
So our conscious effort as a company has always been, especially in these times, to look at profitable businesses, and we've tried to focus on businesses which give us a higher margins, and that I don't think we've done structurally anything different, to answer your question first. And we've just been very, very selective when we go out and take the orders. There are all kinds of orders in the marketplace, all kinds of price points at which we can pick up. So we've been a little more selective to ensure that when on the year-on-year basis we've had a drop in revenue, we try and ensure that we maintain a particular level of gross margins and operating margins for the company. So nothing very different.
Question would be, is this sustainable because a lot of smaller distributors or sub-distributors have exited the business, or whether once, if we get back to growth post-COVID, we're likely to go back to a lower sort of long-term 2%, 2.25% margin?
So one more element I would add to that is there has been some cost rationalization also. While some of it is sustainable, some of it will possibly come back also, because we've really tightened the screws a little too much. So I think that was a second element to it, apart from trying to focus on higher margins, and second is the cost rationalization. Now, in terms of, we've not seen many or any partners exiting the business or anything of that kind as we speak. And I think all these partners IT industry, as I mentioned in my statement, has been one of the relatively unaffected industries, and therefore these partners will continue to sustain and grow the businesses in the years to come. Now, the last part is whether this 2.75% is sustainable. I would say if you look at a trend for throughout the years, we've been operating at maybe in the region of anywhere between 2.3 to 2.5. So it is going to be our endeavor to work at that level, and if we can sustain it, it would be wonderful. So again, we are going through a challenging quarter, and therefore, there'll be a lot of imbalances taking place, which hopefully should get settled down again from Q2 or Q3 this year.
Got it. And just the working capital, just to push the point by the prior participant, our revenues are down roughly around 5 to 10%, driven by the 1Q21 number for obvious reasons. So working capital is sort of flattish year on year. I guess working capital is a function of the revenues done in the last quarter. So that makes sense. I just want to get your sense on the reduction seen by our large listed player in their India working capital versus us. What do you think has sort of driven this? Why haven't we been able to get our working capital down to those levels? Have there been certain brands carried by that competitor, the large listed competitor, that have given favorable terms that have enabled it to do so? And what really has driven that, and why weren't we able to get this sort of reduction?
So we know the company that we are talking about, and let me acknowledge and appreciate what they've delivered is a fantastic performance, and something we would love to follow and implement. I think there are two aspects to it. One aspect is the product mix plays a very, very important role. If the working capital cycles in the consumer part of business, which comprises of PC, peripherals, and mobility, the cycles are relatively shorter. In fact, mobility is the shortest. Enterprise cloud, the cycles are relatively larger. Now, if you would have noticed that their mobility play itself is in the region of about 27%. Their consumer play, of course, has not been separately defined, but it is fairly large. So that is the biggest differentiator, because the working capital cycles in those product categories are shorter vis-a-vis the enterprise. And our working capital cycles, because of this reason, are higher. And number one. Number two, there has been some, I would say, because of the prevailing situation in the economy, where payments, etc., were a little delayed, even though there are no defaults that we are concerned about. Year over year, our net working capital cycle has gone up from about 43 days to about 62 days.
Understood. And was it also driven by a lot of IT companies, instead of buying hardware in bulk to place in their offices, instead giving their employees who are working from home a sort of fixed sort of sum or stipend, and telling them to go ahead and buy certain okayed pieces of hardware, wherein that sort of came in under consumer sales instead of enterprise sales as it would otherwise have. Was that also a factor? A lot of enterprise spends actually going through the consumer route to FY21?
Not really. When we say consumer, we talk about consumer class of products like laptops, printers, etc. And when we say enterprise, we talk about enterprise class of products like network, infrastructure, storage, software, security. So these are product classifications, and I don't think the buying pattern, whether the corporate buys it or whether the consumer buys it, would have a significant impact on the working capital cycle of the business.
Okay. Just a question. How big was our enterprise business in 20 and 21 as a percentage of total sales?
So our enterprise business in FY20 was about 40%, and in FY21 it is at about 45%.
Got it. Thank you.
Thank you. Ladies and gentlemen, you may press star and one to ask a question at this time. The next question is from the line of Raj from RR Securities. Please go ahead.
Yeah. Hi, sir.
Hi.
My question was basically during the year our debt has gone up by about 100 odd crores. So what is our plan going forward? Do we plan to take further debt or are we planning to reduce it? And what would be our target debt to equity ratio for the same?
Yes, our debt has gone up this year, short term by about 50 crores and long term by about 50 crores, total by about 100 crores. It is primarily as I think two things have played a role out here. One is the inventory and receivables have gone up. Number two, we have ensured that we honor our commitments to our vendors, and therefore our payables have gone down. So that is the reason of this debt going up to that extent. Now, moving forward, while it may not be possible to reduce the debt, I think one thing that I mentioned earlier also, and I maintain that moving forward we will look at growing with a balanced growth between equity and debt, and we will look at equity infusion so that the growth is not driven only on debt. Now, we've not yet formed up our plans because this is something that we will take a view from time to time. We want to ensure that we get the fund infusion at the right price so that the company benefits out of it. But that's definitely something on the cards.
Okay. Any number that you would like to put on to the debt to equity ratio as a target?
The reason I am not able to put on a number at this point of time is because we've still not chosen the quantum of funds that we will be raising by way of equity and at what time it will come in. So that's the reason I'm not able to put a debt equity ratio. But one thing is very, very clear. Moving forward, the debt equity ratio will only improve, and that's one thing that we want to work towards.
Okay. Sir, another question would be what is our cost of funds for this financial year, FY21, vis-a-vis FY20? Did we see any reduction in cost of our funds overall?
Not really. The cost of funds have more or less remained the same.
Oh, okay. And that would be?
Cost of funds varies, but our average cost of funds is in the region of about 10.5 to 11%.
Okay, sir. That's it from my side. Thank you.
Thank you.
Thank you. The next question is from the line of Aditi Sawant from ADM Advisors. Please go ahead.
Hello. Thank you for the opportunity. I have two questions. First is, could you give us segment-wise revenue contribution for Q4 and FY21? And the second is, what are the initiatives company has taken to reduce cost, and are they sustainable?
So, segment-wise revenue, I can share for the year. We've broken it into 4 businesses: the consumer, enterprise, cloud, and hardware services. The consumer business would be in approximately 54%. Enterprise would be at about 40%. Cloud would be at about 6%. And hardware services is at about 0.5%. Earlier I had mentioned hardware services at 2%. I think that was a mistake. Hardware services is at about 0.5%. So I correct the same year with it.
And second is, sir, what are the initiatives company has taken to reduce cost?
Yeah, I'm sorry. In terms of cost, this was one area where it's been a tough call because these are not the times that we want to look at any short-term knee-jerk reactions. And as one of the, while we didn't want to ask any of our people to leave, but for whatever reasons, wherever people were moving on to pursue other opportunities, that was one area where we did not fill those positions. So that was one way of rationalizing on our employee cost. That was one thing that we did. Second is in terms of operations, supply chain management, in terms of market development expenses, all these areas were where we really tightened the shoestrings. And while all of it is not sustainable, some of it is definitely sustainable. These are the other areas that we looked at. Third, along in our operational expenses also, I would also like to mention and thank a lot of our, I would say, we've been working on the leasehold premises across India. We have almost about 85 premises that we lease out for our operations. So a lot of our landlords or lessors have come forward and supported with reduction in rentals, etc. So it's been several factors that have worked that would have helped us in reduction of these costs.
Okay. Thanks for the explanation, sir, and all the best for upcoming quarters.
Thank you.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Nikhil Bhargav from inrbonds.com. Please go ahead.
Hello. Sir, I joined the call 5 minutes late. I'm sorry if the question is in repetitive nature. I went through your presentation and it says you're targeting around 7,000 crore revenue in the medium term and cloud computing being the next growth engine for your business. Can you just give me a highlight? Globally, the cloud computing has been the growth engine for being Microsoft or Amazon. So can you just tell me what is the market penetration, if you have any fair idea in India, or what is the penetrated market for cloud computing, and what do you expect the margins from this particular business going forward?
Thank you for your question. Cloud computing is, of course, everyone knows. I don't need to talk about cloud computing. And as a market size, at this point of time, the exact data is not available in India as to what is because it's a very, very fragmented market at this point of time. So I will not be able to share that the market is maybe 500 crores or 1,500 crores. But it is a very rapid growing segment. We are seeing that happening. For example, if I were to talk about Compuage, our cloud computing business year over year, which was at 2% of our revenue, has now grown to about 6%, and we still have a very small play. So we've just started really all the development activities on this front now, and I'm very, very sure that as we move, we should. I don't want to make any statements for futuristic statements, but in this call informally, I can very clearly say that we'll be aiming at double digit as far as FY22 is concerned. So that is one thing. Second is in terms of the margins. While it offers higher margins, this is a business where we still are in the investment mode. We need to make a lot of investments, like we need to develop our own portal to support the partners. We need to have a lot of technical people to support the partners. We will need to bring a new set of salespeople to drive sales of these product lines to the partners. So that will balance off the higher margins that we make in this period of investment. But later on, I'm sure as we achieve economies of scale and the infrastructure is in place, then we'll be able to that will contribute for higher bottom line for the company as well.
Okay, sir. So one last question. So under the cloud computing, we'll be selling it under our company brand name only, right? So or we'll be doing it under Microsoft. We'll be selling in Microsoft Azure or something.
No, we are a pure distribution company. We don't plan to have any of our own products. We will be selling of all the brands directly. Like currently, we have Microsoft as one of our major vendors in cloud computing space. We sell the entire Microsoft cloud computing products, Azure, etc. Likewise, we have signed up with Acronis. We are in discussions with more brands. So the way we sell hardware products, software products, we will sell cloud computing. We are not a product development company. So we will ride on all the big brands in the cloud computing space.
Got it. So what actually makes difference if I have to go to the directly Microsoft Azure or I have to come through you? So would there be any different any package that I will be receiving from you, or is the same? Or how does it work?
So it is how it works is, let me first explain you the supply chain part. Microsoft bills to Compuage, Compuage bills to a partner, and partner bills to a customer, which could be you, your company, or anyone. We do not sell to end customers directly. Our entire business is rooted through partners only. B2B. So, and you may approach your system integrator, and your system integrator, you may approach any of the system integrators in the market. Likewise, a system integrator has option to purchase from any of the distributors in the market. And the prices would be similar, plus minus whatever little additional discounts we give depending upon what kind of support we need to extend to the reseller. So there is not much of variation in the prices, and the product obviously is the same one.
Okay, sir. Thank you. That's all from my side, and all the best.
Thank you.
Thank you. The next question is from the line of Asim Bharde from DM Capital Advisors. Please go ahead.
Yeah, hi. I just wanted a clarification. Your enterprise business is 40% of revenue in FY21. What was it in FY20?
FY21, our enterprise and cloud business both put together was at about 46%. Enterprise and cloud business in FY20 put together was at about 41%.
Okay, thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question at this time. The next question is from the line of Nagraj Chandrasekhar from Laburnum Capital. Please go ahead.
Hi, thanks again for the follow-up. Just a follow-up to the prior question on cloud. Now, we are signed up as a reseller of Azure Cloud, and we will be competing with this. For this, who will be the typical customers that our partners would be selling to? Will be extensively, completely SMBs? And apart from just the cloud space resell, what other things would be sort of cross-sell along with that? I see the Acronis tie-up for cloud security, but typically, what all would you sort of cross-sell? And let's say you have a customer who you've sold X amount of cloud space or cloud compute to in a year. Is that a recurring annuity revenue for you that grows along with that customer usage of Azure Cloud, or how really do the economics work for us? Or is it a one-time fee sort of arrangement?
So now there are resellers coming up. Earlier, there were resellers selling network infrastructure, software, cloud, etc. Then we saw resellers coming up specializing only in software products and selling cloud as well. Now we also see resellers coming up who are focusing only on cloud-based products and specializing in it and providing support to their set of customers. So there are a mixed set of customers that we are addressing. Some who are servicing all the product categories, some who are only in software, and some who are only in cloud. Again, there are resellers who specialize only in one set of product lines, maybe security. Somebody could be doing in terms of storage. Somebody could be doing in another area. Likewise, there are some. So what we try and do is, our goal is, as an organization, we want to, let's say, Azure. We want to reach out to every possible system integrator or a reseller who is serving customers in the Azure space. So our goal is to reach out to everybody. Some could be standalone, some could be selling along with the other product categories. One other goal that we have set for Compuage this year, we have said that we want to become the largest distributor contact point for partners who are serving the MSME space. That is micro, small, medium enterprise space. That is the space. If a partners are serving, let's say 5,000 partners are serving that space, we want to be the largest distributor in that space. That means we want to have contacts with all these partners. We want to engage with all these partners. So that is the goal that we are working with. And now how this works is, this is typically an annuity business. Could be monthly, could be quarterly, could be annual, depending upon what package the customer and the reseller for the customer having signed up with us. And it is a recurring revenue basis, the sign up. Of course, some products have exit clauses, some don't have exit clauses. It's typically how we enter into packages that are available with various vendors.
Got it. And just, is there a certain grade of Azure reseller? They have categories, right? What category are we with Azure? And is there significant pricing differences across categories of Azure resellers that enable you to compete more on price to the end system integrator or customer? Just want to get a sense of that.
So there are various categories of resellers. We can define them by their focus business. We can define them by their revenue. We can define by what customers they focus on. So there are various ways, and these classifications differ from organization to organization. We are indifferent. Anybody selling, let's say, cloud computing, anybody selling within cloud computing, anybody selling Azure, it is our goal and our job to reach out to every single system integrator reseller in this business. We have to engage with them, and we have to try and get their business. Then it's a different matter. There are three things or two things that differ, that differentiate with whom the reseller places the order on. One is, of course, the engagement, the relationship. Second is what support they require from us. Some resellers don't require support, some require technical support available. And third is the price and credit we offer to them bases the extent of support that we need to extend to them. So that is where then the reseller or the system integrator decides to whom, which distributor that they would like to place the order. There is a small area that is the support and the credit which helps us determine what discount structure to offer. The price is fixed, that the gap is only on that additional discount of maybe half, 1 or 2% that we would like to pass on. Whether we pass on or no depends upon our commercial offerings to them.
Understood. And what tier of Azure reseller would we be? There are tiers, right? So is there a specific tier that we are in? Or?
No, there are no tiers of resellers. There are no layering allowed in this business. So Compuage sells to one reseller, and that reseller has to sell to an end customer only. So there are no layers. It's not that we sell to a larger reseller who sells to a smaller reseller, and then it goes to the end consumer. So the resellers get defined by the size or the focus of the business or the focus of the customer, but there are no layering as such.
And this last question, there are 30 million sort of cloud revenues now. What do you think cloud penetration is within, typically for us SMBs or slightly smaller corporates would be our sort of bread and butter. So what sort of penetration do you think we're at now? I just want to get a sense of what the 30 million can get to size-wise.
I'm unable to answer the question because I'm not sure on the market sizing on this segment at this point of time. The way India is low in penetration of hardware, likewise we are way behind the world in cloud penetration as well, is all I can say, and the potential is huge.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. As there are no further questions from the participants, I now hand the conference over to Mr. Atul Mehta for closing comments.
Thank you everybody for joining the call. I hope I have been able to answer most of your queries. In case of any further queries, you may contact SGA, our investor relations partners. Thank you and stay safe and stay healthy.
Thank you. On behalf of Compuage Infocom Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.